Welcome to the Daily Brief, where I'll go over the action in the market for Tuesday, March 14th, and then we'll see how things look for Wednesday, March 15th. Not really surprising, we saw a bounce. Not enough to really change the technical picture, but we'll be watching this to see, are we getting ready to go more in the other direction, meaning up, or are we just working off this short and even somewhat intermediate term oversold condition before we get set to go lower? We almost broke through the 200-day moving average, but we hit resistance right below that level in Tuesday's session. The market isn't quite ready to test that level, at least yet. We'll see if things turn more positive now. So let's go back and talk about what happened. Right at the open, we had a gap higher open. The market seemed to react positively to the CPI report that came out. Prices went above R1 at 39.04. Then we hit resistance at just under the 200-day simple moving average at 39.39. As the day went on, prices retreated back below R1. It looked like things were turning back more negative, but we rebounded and ended up closing just above R1. We were up 1.68% on above average volume, so that's pretty healthy. The technicals, as I said, are still mostly negative, and we're just working off this oversold condition. We haven't shifted yet to a positive stance, at least yet. We'll be watching to see if that's what happens. Inflation and interest rates are still the real backdrop for the market right now, and we're also still hearing in the news a lot about this banking problem, and will that lead to a contagion where it's isolated right now in just one or two banks? Is that going to bleed out into other banks and eventually into the financial sector and the stock market and then potentially even globally? We don't know that yet. You can make a case for either side right now, so we just stay in the background watching what's going on, watching charts to tell us what's happening, and then make our decisions based on that. Here's the intraday chart. It was finally working in Tuesday's session. We gapped higher above R1. Came almost up to the 200-day simple moving average before falling back. It looked like things were like, okay, this was a sucker's rally right here. We're going to start heading lower, but we were able to stabilize as we chopped around, and then some buying came in late in the day to take us back above R1. What are some comments that we can make? Weak banking stocks rebounded. They've just been getting hammered lately, so some of those saw some nice bouncing. Also, on a geopolitical front, there was a U.S. Air Force drone that was forced down by a Russian fighter jet over the Black Sea. We want to keep an eye on these types of things that happen because they can sometimes escalate to something bigger. On a short-term basis, our stochastics are still oversold, and I'll show you that chart. Intermediate term, our Arun, you could still say, is extreme negative, the PMO study and the BPI. And I have charts to show all of those to you. The dollar was up and interest rates were up. We'd been seeing the dollar fall and interest rates really going down. They bounced in Tuesday's session. All of our yield curves remain inverted. The 30 to the 5, which had gone normal after yesterday's session, well, it's back to being inverted again. Sentiment is still negative. We're getting a reading at 26, where it closed last time at 25. Our trend is negative, but it's getting stronger. We're still above the moving average, but we're below 20, so that's still technically a trendless environment. Our bias has been switched over to positive with the up day, and our momentum, I'm still keeping it negative. Looking over the last 2, 3, 4, 5 days, it's been mostly negative. The economic reports that came out, this was the biggie. The CPI came in at plus 0.4% on a month-over-month basis, and that was as expected. So that didn't really cause a lot of movement, positive or negative, in the market. That equates to a 6% year-over-year reading. And last time we had this report, it was at 6.4%. So on the headline, it looks pretty strong. The core CPI, when you take out food and energy, it was up 0.5%. That was more than the 0.4% they had expected. That works out to 5.5% on a year-over-year basis. Last time it came in at 5.6%. The Small Business Optimism Index came in at 90.9. Last time we had this, it was at 90.3. So a little bit of a tick up here. Now, this is a chart that I get from shadowstats.com, where they take the official report that came out at 6%, but then they go back on this chart and say, how did we calculate it in 1990? If that was the case, this blue line would be at about 9.5% or so. That's just a guess. I'm trying to look at this on the chart. Now, what's even more unsettling is if you go back to how they calculated CPI in 1980, we would be at 14.1%, where the official number was at 6%. So that's quite a big difference. Giving an update as to where do we stand as far as raising rates at the March 22nd meeting. On Friday, March 3rd, there was a 71.6% chance that they were going to raise rates 25 basis points. This is after Chair Powell gave his talk. It switched over to 50 basis points. Right now, there's an 80.5% chance that they will raise rates just 25 basis points. You can thank the banking problem for that. There's a lot of fear that maybe the Fed shouldn't even raise interest rates at all. They're kind of sticking behind that they need to do this because of inflation, but at least they're lowering it down to a 25 basis point hike. And there's even 19.5% of market participants that thinks that rates will be unchanged. We still have a number of days to go before this meeting, and look how fast things developed last week. What's going to develop between now and then to change this scenario? We don't know yet. The Ulcer Index is right about at the moving average right now, showing that fear has picked up slightly, but it's not necessarily getting extreme based on this chart. Here's the VIX, how we really spiked up on the line chart and on the bar chart. Since we had the update, the VIX did decline slightly, and the VIX of the VIX is also showing that volatility, although still high, is starting to slow down. The VIX chart with the RSI 9 on it did show us an extreme positive reading, meaning that we went up pretty far, pretty fast. That's starting to come back down. The equity put call ratio, after spiking up, has been coming down slightly with the up day. If we take a 5-period simple moving average, it's still continuing to go up. And what's interesting is we're getting above this 0.8 level, which a lot of times marks an extreme reading with the equity put call ratio. Other times when we had extreme readings like this, that often marked a bottom in the S&P. Looking at our trend, we're turning up with the ADX. We're above the moving average, but we're still below 20. The red line is on top, even though it's decreasing, and the green line's on bottom, even though it went up slightly. Looking at our daily chart, we were able to get back above this descending trend line, but you can see the red line here is the 200-day simple moving average, where that is acting as overhead resistance. On the bottom, you see that we've had a number of days now of volume that is above average. Here's the 2-year look at that same chart, showing how we're trying to come back above this downward trend line. Our rune is still extreme negative. It's turning up just slightly, showing that sellers are in control. Buyers are starting to come back in. That's why we saw the slight turn up with the oscillator after giving us a pretty extreme negative reading. Looking at growth versus value, growth did outperform value pretty much across the board. What was interesting is I was watching this during the day, and for a large part, when we were really going up early in the day, value was outperforming growth. But that buying that we saw coming into the market at the end really helped push growth up higher. So that could be another positive backdrop for the market. Looking at our high beta stocks ratio against the equal weight S&P 500, fear is starting to come back down, which we're still in a risk off type of scenario. We're going to have to see up days on multiple occasions for the risk on stance to come back into play. Stochc RSI is no longer extreme negative, nor is the Williams percent R. Force index also not extreme negative now. Our stochastics, short term, coming out of extreme negative, still just barely coming out of extreme negative with the intermediate term. We're still headed lower with our long-term stochastic and still in extreme negative territory. The rate of change going back 5 periods after giving us an extreme down reading has now bounced back up. Looking at our moving average tree just shows that we're bumping right back into this 200-day simple moving average. The RSI based on 9 periods, which had given us an extreme negative reading, is now starting to go back up, but we're still below 50 with both of these charts, so that is negative. The parabolic SAR continues to have the dots on top, which is negative. The Chaikin oscillator turning up after what you could say is an extreme negative reading. Our PMO study bouncing up with the PMOs that are rising after giving us an extreme negative reading. We're still extreme negative with the buy signals, even though that's showing some improvement. The PMOs that are above 0 continue to decline. The Swollen Trading Oscillator, after just barely going extreme negative based on price and volume, is now starting to turn up. The BPI, which dropped below 30, is ticking up slightly. You can barely see the bars right here, but it's still extreme negative, although it's showing just a tiny bit of improvement. And the NYSE Bullish Percent Index continues to drop. Chaikin Money Flow also continues to decline. Our moving average study bouncing back up with the 20-period moving average as well as the 50 after giving us extreme negative readings, and we're turning up slightly with the 200-day exponential moving average. The CCI 14 is no longer extreme, and we're just a little bit extreme with the CCI 20. The balance of power is still below the dashed line. That's negative, but it is showing some improvement. TTM squeeze going back to a pale red now, which is showing a slight improvement, but still negative overall. We're still seeing a lot of deep purple bars for the go, no-go system. We're bouncing up a little bit from this anchored moving average going back to the COVID low. This could be providing some support, even though we broke down a little bit below that. Our short-term Feb levels, after coming down to this 38.08 level, we've been bouncing up off of that so far, and we're just above this Fib level at 39.20. Our longer-term Fib chart also shows this 38.26 level continuing to hold. We got close to that level on Monday, but we're starting to bounce back up. Our weekly chart also shows the 38.09 level holding, and we're well above the 200-week moving average. So far, support is holding. The Elder Impulse system has switched back to neutral. Our McClellan oscillator, after going extreme negative, is now bouncing back up, but it's still negative. Our broader measure of the McClellan oscillator is also coming back up after being extreme negative. Summation index based on price and volume continue to decline. That's negative. I'm not really seeing a breakout in new highs yet, so our 5-period moving average and our 10-day continue to go lower. The advanced decline line still below this moving average, but showing a little bit of improvement. Our advanced decline ratio with the 19-period exponential moving average after going extreme negative has bounced back up, but we're still below zero with both the blue line and the red line, so that's negative. Accumulation distribution turning up slightly, but still below a declining moving average. Volume continues to pick up currently. The financial sector just ticked up a little bit when you compare it to a ratio of the S&P 500. The banking sector was up 1.93% after just getting hammered. And the regional ETF also bounced back up 1.78% after getting just decimated. Here's another regional banking ETF up over 2%. And then the regional banking ETF, looking at the financial sector as a ratio, it's still headed down overall. Looking at the S&P to the S&P equal weight, still showing that the bigger stocks are holding up better. The Dow was able to get back above S1 here, but we're still below its 200-day moving average. The diamonds have switched back to neutral. The Nasdaq also kind of finding a mess here. Could be getting close to a golden cross. We'll have to see if price can continue to go up. The Nasdaq 100 also faring a little bit better and just starting to give us a golden cross. The Qs have now switched back to positive with a green bar. And the small caps, after really getting decimated, tried to bounce back a little bit but hit resistance at this S2 pivot level. And then the Russell 2000 small cap index, after really going down heavy, did show a bit of a recovery bounce, but with the RSI up above, we're still extreme negative, and the MACD continues to decline and is below zero. The small caps have switched back to neutral with the Elder Impulse system. The small cap ratio to the S&P still continues to show a breakdown. The mid caps also, after really getting hit hard, came back up but cannot break through its 200-day moving average, at least yet. And the mid caps have switched back to neutral with the Elder Impulse system. Looking at the home builders, we're still holding up fairly well as far as the home builders to S&P 500 ratio. We're seeing a little bit of a tick up here. If we continue to go down, that could potentially be a positive divergence, so we're watching this. The 10-year yield, after getting above 4% not so long ago, now is down around the 3.45% level. Well, it ticked back up above 3.6%. And here's the bond prices, after really going down, have spiked back up, but are now starting to fall back down. The RSI is declining, but still above 50. The MACD continues to be in an uptrend. Looking at our economic fear gauge, it is spiking up a little bit, even though it ticked down slightly in Tuesday's session. Our long-term trend analysis, this is what we're keeping an eye on. This MACD is starting to roll over here. It's still above zero, but if we see some more weakness, this MACD could continue to go down, which may then suggest that this breakout above this trend line is a fake out. Looking at some of our possible positive scenarios, this is a positive backdrop that's developing. The Qs are outperforming the S&P. Discretionary is still underperforming, but showing a little improvement. The large cap growth to large cap value is outperforming. And then looking at our growth to value ratios with the large cap doing well, mid caps well, and small caps well. So if we do get to the point where the market really starts to go up, this could help fuel things to go higher. We're still turning down with our 50-period exponential moving average, the new highs minus the new lows. We show a little bit of improvement overall here with the indicator reading, but we need to see this turn and get back above zero for things to switch back and look more positive. The advanced decline line ratio based on price after getting extreme negative is bouncing, both based on price and based on volume. This could give some support to the market. And then our broad look at the Amex, NASDAQ, and NYSE highs minus the lows, and then taking a 5-period moving average, this continues to decline and is below zero. Looking at our 2-year Treasury yield after spiking up, it has been coming down. We'll see. Is this going to end up giving some support to stocks? And then our staples to S&P 500 ratio starting to come back up, but we're still working off of this spike that was set right at the end of 2022, which is supposed to be giving some support to stocks, but hasn't quite done that, at least yet. What's our outlook for Wednesday? The technicals are negative, and right now we just have to say bouncing from short and intermediate term oversold. We have the MBA mortgage applications coming out, the Empire State Manufacturing, retail sales, and PPI. Another big day for economic information. And then business inventories, the NAHB Housing Market Index as well. The geopolitical events, we want to keep an eye on that drone situation between Russia and Ukraine. That could potentially escalate. Inflation and interest rates are what the market's really concerned about. And then the news is still fixated on this banking problem, wondering if that will turn into a contagion. Looking at the Stock Traders Almanac statistics, now that we're getting into the mid-month, we tend to see more strength in the S&P 500, but then some weakness may develop later in the month. Looking at March 15th itself, we tend to be quite positive with the Dow, up 71.4% of the time. We're neutral to positive with the S&P, up 57.1% of the time, where the NASDAQ tends to be more negative. It's below 50%, so it's neutral to negative at being up 47.6% of the time. And then all the other things that I'll quickly scroll through this time. I just mentioned this stuff from time to time in the videos. I don't want to bore you with the same information all the time. Then looking at the 11th trading day of the month, we do have a tendency, the green line here, to be positive. And we're still in that pre-election after midterm bear, which is the gray line showing that this is favorable. And then we are also in that sweet spot for the S&P 500, which is generally returned about 20% during this time. It's really going to have to get going if it does that. Looking at our scenarios, you could technically go with the down scenario, although if we have another up day, you're not going to want to go against that because the ADX is starting to get above the moving average. If you're more aggressive, you like that already. You don't really want to go with the up one yet because this so far just looks like a bounce. We'll have to see more follow through and then look at our charts to see if things are switching back more positive. Even though we have a lot of potential positive backdrops that could really help the market, we're not seeing that really follow through into price at least yet. So we're still going with the sideways trend overall. Even though the ADX is strengthening, it's still below 20. The red line's still on top, so we default to the negative. So our conclusion, the S&P is negative and it's only bouncing at this point. We're going to have to see more follow-through buying. Short-term negative but bouncing, intermediate-term bouncing. Long-term, we're still below the 200-day moving average, so that is negative. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.